after we talk about bonds and bond valuation in Chapter 7, now in Chapter 8, we're going to talk about stocks and stock valuation. So I have a link here for you to check out a video from Khan Academy about the difference between bonds and stocks. So I highly recommend you to check it out. What is a stock? What is a common stock? A common stock is a so-called equity security, and equity securities represent ownership in a corporation. So if you hold common stocks in a company, you are one of the owners of the company. And what you have would be the so-called residual claims. So that means you have a claim on cash flows only after all other claimants have been paid. And the other claimants include the employees, suppliers, debt holders, and the government. So think about the cash flows from a company as a big pie, and the pie will be split and will be paid to the other parties first, and then shareholders can get those part of the pie. And how much can they get? Of course, that depends on the performance of the company and whether the company can successfully fulfill the promise or obligations to the other parties. So sometimes we would call it a leftover, so residuals or leftovers. At any point in the stock market, how much a company's stock would be worth, that depends on many factors that include the company's profitability or how much cash flows they can generate, and the company's growth potential, and also market conditions such as the market interest rate and the overall stock market performance. So, why do we need a stock market? A stock market or stock exchanges provide so-called liquidity. So, the liquidity in the market means the ability for owners of common stocks to convert their shares into cash at any time. So, if you buy, for example, if you buy 1,000 shares of Google stock, and if you are told that once you buy them, you have to hold them for at least 10 years and cannot sell them, or you cannot sell them unless you pay a pretty hefty penalty, would you still be willing to buy the stocks? A lot of people would hesitate to do that, even if Google is actually a pretty, profitable and successful company. So you understand the concerns investors would have if the stock market cannot provide liquidity for them when they want to sell their stocks. So in the United States, we have the major stock exchanges. We have the NYSE, which is the New York Stock Exchange, and the NASDAQ. NYSE is considered the largest equity-based exchange in the world based on the total market capitalization of its listed securities. So total market capitalization of its listed securities, that simply means the total value of all the stocks in that market, or say the total value of the companies that those stocks represent in the NYSE. NASDAQ was created by the National Association of Securities Dealers to enable investors to trade securities on a computerized, speedy, and transparent system. So it's an electronic system. So the two stock markets or stock exchanges, they are very different, and let's see the difference. So first of all, in terms of location, on the NYSE, trades occur in a physical place on the trading floor in New York City. So if you have been to New York City, you go to Wall Street, you can see NYSE. You can see the building now. I have a video here, so if you click on this link, you can go to YouTube and watch this video, which is a tour about the NYSE trading floor. It's a pretty interesting video to watch. The NASDAQ, on the other hand, is operated on the telecommunication network. Trading takes place directly between investors and the market makers. Second, we call the NASDAQ a dealer's market, while the NYSE is called an auction market. So in the dealer's market, market participants are not buying from and selling to one another. Instead, they go through a dealer or say market maker. So buyers will buy from the dealer and sellers will sell to the dealer. And the dealers, of course, make a profit from buying at a lower price and selling at a higher price. NYSE is an auction market. In this auction market, individuals typically buying and selling from each other, and there is an auction. So the highest bidding price will be matched with the lowest asking price. Third, what is a market maker and what is a specialist? On the NASDAQ, the market makers transact with buyers and sellers to keep the flow of trading going. Again, they buy from the sellers and they sell to the buyers. And on the NYSE, specialists are more like a matchmaker, and they are in charge of matching up buyers and sellers. So they do not trade directly with the buyers and sellers, they just match up the buyers and sellers. And so that's why we say a market maker creates a market for a security, whereas a specialist only facilitates it. The duty of both the market maker and specialist is to ensure smooth and orderly market for their clients. Speaking of the perception, the NASDAQ is typically known as a high-tech market. So if you look at some high-tech companies such as Google, Apple, Facebook, their stocks are listed on the NASDAQ. And usually those stocks are considered to be a little bit more volatile and growth-oriented. So they may have a lot of growth potential, but usually they also have a lot volatility. Companies on NYSE, on the other hand, are perceived to be more well-established. So its listings include many of the blue chip companies and industrials, and the stocks are usually considered to be more stable and established. So for example, if you look at AT&T, Procter & Gamble, and Walmart, their stocks are listed on the NYSE. So they may represent a little bit more traditional, more mature companies, while NASDAQ represents a little bit more growth-oriented and high-tech companies. NASDAQ is significantly less expensive than NYSE. So if we look at the cost for companies to list on those exchanges, the entry fee for a company can expect to pay on the NYSE is up to about $250,000, while on the NASDAQ is only about $50,000 to $75,000. And annual listing fees are also very different. On the NYSE, they base on the number of shares of a listed security, and they are capped at $500,000, while on NASDAQ, the annual fee is coming at $27,500. So maybe we can understand why the growth type stocks, usually the companies with less initial capital or a little bit smaller at the beginning, they will be found on the NASDAQ. And the materials of these two slides are based on an article from Investopedia, and I have a link here, so if you are interested, go to the website and read that article. Now, we also have to say that financial exchanges, they're also evolving. So they are changing rapidly, and many changes are shifting from physical flow trading to electronic system. For example, for NYSE, even we still say NYSE has a physical trading facility or floor, bigger and bigger percentage of the tradings now also occur on an electronic basis. Also, exchanges are merging and becoming larger with international focus. So how do we track the stock market? How do we know if the market is going up or down? To determine the overall direction of the market, we use stock indices. So there are dozens of stock indices used to track different segments of the stock market. If you are interested, click on this link embedded here to go to the market page of the CNBC website. You can see all the major indices there. And the three most recognized indices in the United States are the Dow Jones Industrial Average Index, the Standard & Poor's 500 Index, and the NASDAQ Composite Index. So the Dow was invented back in 1896, and back then it consisted of 12 companies. And now it has 30 companies, 30 large firms, and they represent total of 30% of the total US stock value. And the way they compute the index, it was computed by adding up the stock prices and divided by 2. And today, it's a little bit different. But the index is still a so-called price-weighted average, which means its value is generated by adding the prices of each of the stocks in the index and dividing them by the total number of stocks. Now, you are not required to know about the definition or the calculation of a price-weighted average. You don't know how to calculate it, but you just need to know that the so-called price-weighted average is generated by adding the prices of the stocks and then divided by the total number of stocks. You just only need to understand this concept. S&P 500 index was created back in 1957, and it uses market capitalization to compute the index rather than the stock prices. So if we say the Dow is a price-weighted index, the S&P 500 will be a market value weighted index. The S&P 500 index represents roughly 80% of the overall stock value. So remember, we just mentioned that Dow, all the stocks in Dow represent about 30%. So 80% here, that means S&P 500 has a broader coverage, and that's why it is considered to be superior to the Dow. Again, because of much wider coverage and the more useful way it is calculated. Again, you are not required to know how it's calculated, how exactly to compute for the market value weighted index, but you just need to understand that they use the market value, or say the market capitalization, to compute the index. So NASDAQ Composite Index was launched in 1971, and also it uses market capitalization weighted average, which means individual stocks are weighted according to their total market capitalization instead of their own stock price. So think about a stock. If the price is $100, so that's the price. But if there are 1 million of the stocks outstanding, then the total market value, or say total market capitalization of the stock, is $100 million. So whether you rely solely on the $100 price or you rely on the 100 million market value, that would make a difference in the calculation of the indices. Because of the dominance of the large high-tech companies on NASDAQ, this index is also considered to be a measure of the performance of the technology sector. So when people see the up and downs of the NASDAQ index, they try to draw conclusions about how the high-tech industry, the technology sector, is doing in the market. So for example, if we look at May 7th of 2014, and on that day, S&P 500 closed at 1878.21, which was 10.49% higher than one day before. And one day before that would be May 6th of 2014. So what is the return in percentage of the stock market that day? The answer to that question, if 1878.21 was 10.49 points higher than one day before, that means one day before the S&P was at the level of 1867.72, which is 1878.21 minus the 10.49. So then the return on May 7th of 2014 would be this difference, or say this change, this increase, 10.49 divided by the base level, which is actually the value as of May 6th of 2014. So 10.49 divided by 1867.72, you have 0.56% increase or growth in one day, from May 6th of 2014 to May 7th of 2014. So if you look at the chart here, you see that on May 7th of 2014, they tell you that S&P 500 closed at 1878.21, and that is green, which is growth, or gets higher, 10.49 points higher than before, and that represents a 0.56% increase from before, or say 1 day before. You can also click on this video here to watch a video from the CNBC website. That video is about a market summary on May 7th of 2014. You will see that they describe how the market moved on May 7th of 2014. And you will realize now you understand the lingo. Now, let's see. How do we trade stocks? To trade means to buy and sell in the stock market. So if you are an individual investor, you will have to open a brokerage account. And buy and sell orders go through the brokerage account to a market maker or a specialist. So, for example, if you open a brokerage account at Fidelity.com, you place a buy order, and the order goes through the Fidelity, and it goes to a market maker or specialist, depending on which stock you are buying. So the bid price, again, is the price at which the dealer will buy. And the ask price is the price at which the dealer will sell. So this is consistent with what we talk about in Chapter 7 about the bid and ask prices. And the difference between the bid price and ask price is called the bid-ask spread, and that is a profit for the market maker or the dealer.